to talk to you today about managing receivables. No matter what kind of business you're in the business of receivables. And I want you to feel free to reach out to me. And if you have questions, I want you to stop me. If you want to ask something, just burst right in and we'll discuss. Because we're a small group today, I think a lot of spring break is happening and people are leaving for vacations. So I just want you to know that I don't want this to be like I yammer on and you don't get to say anything. Let's talk about what is interesting to you and what concerns you have. Like Jacob said, I'm a healthcare and dental services consultant at Wayland, and that's my contact information. So if you want to get in touch with me after the fact, everybody at Wayland, it's real simple. You just put their initial, their first initial, their last name, and then add at waylandcpa.com. And unless you think that this is something that probably doesn't impact people very much, I have very recently been working with people who have spent 15 years in business who have discovered that their receivables were out of control and they weren't aware of it. So it's very pertinent. It's very sad to watch people struggle. You're interested in your business. You're all about your business. It's your life if you're in small business. It's not like you have a business life and a personal life. It's everything. And so I want you to know, with the backdrop of, it's very heavy-hearted to have to deal with people who are disappointed with how their business has gone because they've kind of been asleep at the switch. So if you've been asleep at the switch, I hope that this generates in you some interest to take stock of where you are, brush off whatever you've done in the past, and set some new goals for yourself so that you can fall in love with your business again. One of the things that I want to first of all mention is one thing I run across a lot with small business owners is they don't think they really are confident in their fees. And so one of the big ideas I want to get across to you today is that you're deserving of the agreed upon fee that you negotiated with your client. And I want that to kind of overarch what I'm saying. I'm not about greed, but I am about being paid fairly for what you do. A second big idea I want to get across to you is that when your receivables are lagging, it affects your ability to function as a business day to day. And one office that I'm working with, that's a professional office, discovered their problem, their monetary problem, because of feeling like they needed to go get into their line of credit. And they came to Wayland and they're like, what's going on? You know, we're taking out loans. And Wayland said, let's see your accounts receivable. And that's how I got involved with this particular group, because their accounts receivable were up over $1.5 million, and they're working harder and harder, and they're taking out loans. So don't let that happen to you, right? Just know that if your business is having cash flow issues, this is a place to check, is in your accounts receivable. I also want you to realize that aging receivables is a way to help you identify a fundamental cause of poor cash flow. It's not the only reason for poor cash flow, but receivables that are out of control are a common reason. You could also have poor cash flow because you don't stay open often enough, or you don't offer enough variety, or you're not advertising, or you're in debt. There are lots of reasons for poor cash flow, but having receivables that have not been tracked is a very common, quick way to fix poor cash flow. And then I also want you to walk away today understanding that you should benchmark your aged receivables against the industry that you're in. And the reason that you want to do that is because of other people who have studied, for example, in dentistry, we have people who study accounts receivable for multiple clients, and they report to one another. And so these groups can get databases together, and then they can tell you, hey, this is about how much you should have if you're a healthy practice in 0 to 30 in the current category. And this is about what we would expect in the 61 to 90 days. So if you benchmark against your industry, it helps you identify problems in your business operations. So because I am so committed to the troubles and trials of small business, having been in small business for a number of years, I just liked that Richard Branson, you can't say he's not a businessman, and certainly he's a caliber above probably all of us at this little webinar, but he makes a very salient point. If you take your eyes off the cash flow, you're going to lose the lifeblood of your business. So that's how important this is. So what are accounts receivable? I'm sure most of you know exactly what I'm talking about, but I like to think of it in a few different ways. I try to explain it to people that it's monies owed that are not paid. So your customer received your good or your service, and they're benefiting from it. And you haven't yet realized the full value of that good or service because you haven't gotten paid completely. You can also think of it like a short-term line of credit. Now, the terms that you use in your industry may be 15 and 45, it's kind of industry dependent. In healthcare, it's really typical to see what I have here, the 30, 60, 90, 120 day buckets in accounts receivable. So this is telling you how many days it's been since your patient has not been able to pay for the goods and services that you've provided for them. So you're giving them a loan, but you're not a bank. And so it's important to remember that you're actually loaning someone money or loaning someone a good, and you're waiting to be paid for it. And this one always gets everyone, it's deducted from your net profit. And you know that when your receivables are high, your cash flow is low, you don't take as many draws. So as I like to think of the cash flow absorbing all of that unrealized value that you haven't yet been paid for. And what I see happening a lot, especially in the small businesses, is since it affects your cash flow, the rate at which you collect affects your cash flow. When you're lagging in cash flow, it hinders your ability to pay for the supplies and the labor that you've already done. So you've bought your materials, or you've paid the staff to help you in dentistry, for example, put in the filling or the crown, you're paying the overhead of the office, and you don't have the money to pay your bills. It's tight. You're picking bills to pay and waiting to pay for others. And being cash poor, though, is not just about paying in the here and now, the things you owe, but it also hinders people from purchasing, for example, new equipment that might give them more leverage in their businesses. It prevents people from going to training or taking their staff to training. It prevents people from using an advertising budget or anything else that could be held off because the cash flow is bad. And you think, oh, I'll wait till the cash flow is better before I reorganize this or before I add to the office or whatever. So it actually prevents you from going forward in your business. And as I mentioned, and you are well aware, owners don't necessarily get paid well. Everyone is very enamored with the idea of running their own business. But in 2019, Reuters reported that more than 50% of small business owners pay themselves last. I know I did. A lot of times you have your busy times and your lagging times, and it seems like you're always pushing money around. And I think that's just the nature of small business. And one thing we can do then is to get on board with this accounts receivable idea and get those under control so that we can pay ourselves on a regular basis because we have bills at home that we would like to take care of, or we have vacations we want to go on. So what I see happening is business owners are seeking remedy and activating lines of credit, which puts them more in debt, which means that their lagging cash flow has more obligations associated with it. So it becomes like a cycle. So I'm not saying if you have a bad month where you're just seems like your receivables are in the toilet, that's going to kill your business. What I find though is that people, it's not one time, it's continuous. It's a cycle. Month after month, they haven't paid any attention. And now they only get wise when they start to feel it so tight that they're digging into that line of credit. And it's really hard to deal with accounts receivable when you're the face of the operations and you're intimately associated with your clients. You probably know personally a lot of your clients. And I want to just spend a couple minutes talking about why is it so difficult. I told you in the beginning, I want you to understand that it's on my heart that people who work get remunerated for what they did. They should not be not paid. You did your part, you should get paid. So you should not feel bad. So there are lots of different reasons that I think collecting accounts receivable is difficult, or having money conversations with clients is difficult in general. And the first thing is, I think you make a promise. The person has promised you that if you provide the good or the service, they're going to pay for it. So we've agreed to have a relationship with one another. We're going to work together, and we're going to solve the problem. You have a bad tooth and I'm going to fix it for you. And in exchange, you're going to give me money I need to pay for things that I want to buy or need to buy from someone else. I have problems I need solved. So I need your money so I can go to someone else in their business and let them enter a relationship with me so that they can fix my problems. And that, of course, sets up an expectation. Anytime you have a relationship, if you're married or if you've had boyfriends or girlfriends, when you're in a relationship that has a promise involved, you do expect each party to honor their agreement. And so in essence, in business, just like in relationships, personal relationships, you're igniting trust. You're allowing someone the privilege of being taken at their word. They said they would pay you. You said, fine, I trust you that you will do this. And so you think, and it's not wrong to think this, that you both have that value for trust, and it's going to drive the performance of the agreement. And so since trust is the basis of promise keeping and relationships and expectations, it's problematic when people don't honor their commitments. And another factor that plays in is, everyone wants justice, right? We want to be treated justly. And when we have broken promises, we get frustrated. And then that starts to sever relationships. And that's what I want to stress about the accounts receivable. How does that sever relationships? Well, because now I don't like what you did to me. I don't like that you didn't pay me. I'm going to change the way I deal and do business with you. I might not offer you credit terms next time. I might have to write off a balance, and that annoys me because I felt like we made a deal and you ouched on your part of the bargain. And in reality, if you performed at expectation and you delivered on the promise and the other party didn't, then you're going to have a discord in your value systems. You valued them more than they valued you, and that's hurtful. So I think that's what ignites the conflict about you wrestle with yourself because you don't want to be that person that's down someone's throat. You want to be understanding that people do have issues come up, and that's fine. You can do that on a one-by-one basis. But in general, we've all seen it, right? I can remember at OSU one time they wouldn't let me extract a tooth on a fellow, and he said, I can't pay. And I went and I talked to the instructor that signs off on that, and he's like, absolutely not. We'll medicate him, and when he can pay, we'll pull the tooth. And I went back and told him, and he pulled out the biggest wad of cash I've ever seen in my life. He just didn't want to pay. And we know that that's the reality of it. So it's kind of a personal thing when people don't honor their commitment. So what we're hoping for is this, right? I served you the meal, you handed me the credit card. I signed the loan papers, you gave me the key, or I'm the doctor and I did a service and you passed your card to me. And what we get usually is the brush off. We make those calls and we say, hey, what about that bill you owe me? And they may not care about their promise. And that hurts your feelings, and it makes you start to get that sense of justice being ignited there, and it makes you angry. What's worse, though, is I think the dress down, right, where they intimidate you. Well, you're greedy, or you charged too much, and they've been happy with your service up until the time you asked for the final payments. Or they might even try to coerce you by saying, I don't like the way you do things. I think you overcharge. And then, of course, they want to take that to social media. There's always that threat, even if they don't say it, it's possible. And so they're trying to get you to overlook your promise. And then the worst thing that can happen is the tell-off, right? Where you're angry now and you're inappropriately, because your justice has been thwarted, you're inappropriately angry at your client because of the broken promise. And now you've injured that relationship. And you're absolutely right to think that a lot of times, sadly, that will end up on social media and it becomes something that you have to deal with. So it's not just about money. It's really about forming relationships in business. So I want to give you an action plan. I want you to think about the effect of receivables on cash flow. I want you to realize that receivables are you being kind to someone, extending them a loan of money, and you're being kind because you're offering to trust someone you don't probably know very well. I want you to determine to establish a proactive receivables policy where you carefully outline for your patients the expectations that you have for conducting business with them, and make sure that you do this before you deliver goods or provide services. So this is all front end work where we don't start into relationships. We've been burned before. We know how this works. So going forward, we don't take this lightly any longer. You have to train your staff members on the receivables policy. One thing that I see breaking down a lot of times is that doctors or business owners feel like they have told their staff how they want it to go. And I can remember telling my staff things and then being like, why aren't we doing this anymore? Oh, I think that stopped when Janie left. And I was always like, why? Why did that stop? It was working. So you have to not just train them, but you have to stay on it. You have to yourself. And a lot of small business owners feel like I do, I make the donuts. I sell the donuts. I make the donuts pretty. I get the stuff in here. I do payroll. I don't have time to look at that. That's someone else's job. And you just cannot do that. You will be like the people that I'm working with right now, fairly shocked at the level at which the business was not actually running. I want you to get determined to evaluate your receivables on a monthly basis and then set goals to eliminate the receivables that are old. Because uncontrolled receivables, you just go nowhere, right? You chase your tail in business. You just don't ever get to where your business is satisfactory for earning income for your family or making your dreams come true. And that's why you went into business in the first place, why you didn't want to work for the man. You wanted to chart your own course, and it steals from you your ability to go forward with your dreams. So some considerations about accounts receivable before we go forward. If your business is going to offer credit terms to customers, and I worked in both situations. Our second dental office, we were a cash practice. We filed insurance for patients and they paid us and they waited on their insurance. It's glorious, but it has its drawbacks because receivables are valuable. Having an accounts receivable balance is important because it's money in the pipeline. It's an expectation that you have that's going to turn into cash at a designated time frame. One thing about having a cash practice was you make what you make that day. If you're sick, you don't make anything that day, and there's nothing coming in the pipeline because you collected it all. And that's good, but it's also bad because you can't afford to take time off. There's nothing coming. The recommended amounts are industry dependent. So how much you have in accounts receivable, people like to say about a month's production in the medical world is a good amount of receivables to have so that you have something that's expected to be happening in as far as income in the near future. It's also client dependent. Make sure you don't offer credit to people if they're not reliable. If you've already written off balances, you have to determine in your heart that no matter, it might be a friend, it might be a friend of your brother-in-law or whatever, and you want to do good by these people, but you're not a bank. If the bank won't loan them money because they're bankrupt or whatever else, you should not be entering into agreements. You're going to get burnt. And then make sure that no matter what I say, take home this message. Your business has to develop credit practices that are adhering to the federal and state guidelines that deal with collections. So if you're going to extend credit, make sure you disclose the terms to the customer about how you expect to be paid and the consequences to them if they don't keep the terms. So if I'm going to charge a finance charge, I have to tell them how much it will be, when it will start being calculated. If I'm going to charge some kind of late payment, I have to also express to people that that's what I'm going to do, and so that there are no surprises. And then when it comes to reporting people to collection agencies, you have to be super careful. The laws change frequently. In 2022, kind of a law that snuck in, the No Surprises Act in medicine, which was designed to prevent people who were out of network being treated by out-of-network doctors at hospitals for emergency visits. They were getting these enormous bills, and they discovered from the insurance company that the doctor that was treating them was not in the network. So these people are getting these enormous medical bills, and they're surprised. So they enacted the No Surprises Act to help people not get these giant surprise medical bills that were then recorded on their credit histories. And so the big three, in reaction to this, the big three credit reporting agencies decided to get together. And now in medical billing, for example, if it's not over a year old and if it's not over $500, they won't collect it for you. So it's really important to collect receivables before they get old because, for example, in healthcare, that's really tightened down, and people will know this, and credit reporting agencies will not work with you. I have a dental client that I've been talking to who brought this to my attention and kind of sent me on the research. I knew about the No Surprises Act, but I did not know about the credit reporting. And I was pretty shocked that, it used to be 6 months and now it's a year. So people are going to know that, and they're going to come to see you. They're not going to pay, and they're going to go, it's not enough that they can sue me over or put me on a credit report over, and they're just going to ignore the bill. So the general principles about the AR process are, if you're going to owe people money, let people owe you money, then you need to follow these steps. You're going to have to establish financial policies prior to offering credit. You have to collect your balances, and we're going to set up with our office or whoever does business dealings with you in the office to help you collect money. We're going to decide who qualifies. We're going to write that out. These are the people we're offering credit to. Maybe if you're in some kind of industry where you're selling goods or services, you might be like, well, we're only going to offer credit terms to people who have purchases above this amount or whatever. It might be industry dependent. You can't discriminate against people, obviously, but you can say that the way we do business here is we only offer credit terms to people who owe us, $1,500 or more. You need to decide the amount you'll extend. For example, you might slow something down. It would be really simple to say, yeah, I'm going to buy lumber from you, and I want to buy nails from you. And they could just have basically a whole house that you're delivering to their doorstep. And they owe you this enormous amount of money. And you might be like, well, that's too much money. I'm not willing to let you owe me that much money. So keep that in mind as well. Make sure you set firm payment time periods. Like at 30 days, we're going to send our first statement, or we're going to send our first statement. If you're in healthcare, as soon as insurance pays, the first statement goes out before it's even in accounts receivable. It's seen as current. So we're gonna hit that by as soon as insurance pays, we print a statement and send it out. However that works, make sure you have a time period firmly established with your office staff. You might want to consider what are terms if we're going to offer early payment discounts for people who pay in cash. How much is that going to be? How are we going to calculate it? I mentioned late payment fees before. How will they be assessed? How much will it be? How often will we do that? If they're late again, will we assess another fee? All those things have to be outlined so that your office staff knows what to do when these situations arise. Like I mentioned, credit conditions are specific to your business. So you need to make sure that you're doing things like other people do. So you don't want to stand out as that guy who doesn't accept any form of payment or whatever. You want to see what conditions are specific to the business, that industry that you're in. And that will make you more profitable in the long run. And any other, things, you need to do credit checks. If you're, a lumber company, you'd want to do credit check probably before you let people walk off with your goods. And do you want to have them sign an agreement? In healthcare, for years and years, I used a financial policies signature agreement with our patients, and it worked fine. And then when there were balances in dispute, it was easy to say, hey, you knew that whatever insurance didn't pay was on you. The next thing is, when you determine you're going to extend credit and you've got your policies in place, invoice customers. People in small business go, I'm busy, I can't invoice right now. I'll get to that next week. I'll get to that next month. We're busy in the summer, or we're busy in the winter. And those things lag behind. You can't do that. You have to invoice quickly so the terms are not extended, adding days. If you don't invoice for 10 days because you're 10 days late on your invoicing, you gave them 40 days, not 30 days to pay. So you're going to, of necessity, always be running your accounts receivable into those older and older buckets. And remember, the older buckets are harder to get paid back for. There's we'll talk about this in a minute, but there's less of a chance that you'll get paid the older the receivable is. Make sure that your invoices are complete with dates of service and purchase dates, or however it is, your product information, descriptions of products. In healthcare, for example, we always had to put in, this is the invoice, this is how much is left for your crown that the insurance didn't pay, or this is how much is left for your filling that the insurance didn't pay. I know some offices have struggled where patients call and the amount is the same, but they're just angry because you don't have it matching their EOB that they got in the mail. So they're thinking you're not doing it right, even though the amount that they owe is exactly the same as the EOB says. You don't have it categorized right. So don't cause problems for yourself. Make sure invoices are complete. Make sure you indicate to them their due dates if you're giving them discounts, or when taxes have been added, especially for people who have to pay taxes for items that have not been taxed already. My husband works with a lab in California, and they never charge sales tax. So every year every quarter of every year, I have to go in and dig out all of that information and of course pay those taxes to the state. So you have to make sure that you let the client know that they've been taxed if that's appropriate for your business. Make sure you indicate late charges and explain them. That should be the explanation that you gave them when you set up the financial policies. Make sure your contact information and by all means, the type of payment you take. Make it easy for your clients to pay. An office that I've been working with recently have people calling and saying, I know I owe, I haven't gotten a bill lately, so I don't know how much I owe. They're begging to pay you, and they don't have a way to determine it. They've been out of the loop for 15 years on this, and we're catching them up. So make sure if you have comments like a late fee has been assessed, or we won't serve you again until your bill is paid in full. Make sure those comments are all on there. And then make sure that your invoices always reflect the stated credit terms that you set up with the client before you begin working with them. Once you have established your financial policies, related those to your clients, you've invoiced your customers, now you have accounts receivable because not everyone's going to pay. So you have to track it and monitor it. So you have to compile an accounts receivable report monthly and evaluate that for past due amounts. And then you also need to not just look at and go, wow, that makes me mad. I have people at 120 days. You need to act on those. Get those off of there. So make sure that your accounts receivable report should be generated probably from a program you're using to track sales. It should have the client name, the amount owed, the amount that's current. That's the 0 to 30 in my example with healthcare, any past due amount, and the percentage of each of those buckets is to the total amount that's owed you. And I'll show you some examples on a chart here that I made up for us to look at later. And then by all means, manage it. Go in there and find the old accounts and go, here's my cutoff date. So you tell your office manager, look, after 180 days, I want these written off, or I want them sent to collections. Whatever your goals are for your business, whatever your comfort level is for your business, just make sure that you act on the information quickly. Oops. Sorry about that. So prioritize the high value amounts. If you have amounts that are in the thousands of dollars and that's not typical for your business, make sure you get on those fast. The longer it ages, the harder it is going to be to collect. Make sure you have reminders or ticklers to patients or to clients. You might use email, or you might use a text, or you might lay down a phone call. Make sure you're constantly sending new invoices. Now you have to abide by, you can't hassle them. There are rules about collections that you have to follow, but make sure that you're making contact with them, and make sure it's appropriate contact. Make sure it's very business-like contact that doesn't cause any kind of conflict with your clients. So in summary, your age receivables help a business determine which accounts are due, which are overdue, and which need to be turned over for collections or written off. And that's going to come against the current assets part of your balance sheet. So your payment has to be initiated through invoicing. You're going to track it and you're going to manage it. I thought this was interesting. I'm certainly not done with my presentation, but we're kind of changing topics a little bit. We're going to look at the details of accounts receivable. And I thought this was really interesting. You think, well, boy, I feel dumb about accounts receivable. I haven't been paying attention, but here's Michael Dell. We're always focused on the profit and loss statements. And boy, don't we live by those. I mean, my husband was always like, how much should I produce? And I was always trying to go, what about the expenses? And what about the accounts receivable? And Michael Dell says that cash flow was not regularly discussed. And it's like we were driving along watching only the speedometer. And in fact, we were running out of gas. And I feel like that is so typical of small businesses in relation to their cash flow, which is obviously tied to their accounts receivable.
Hey, Lori, we have a quick question in the chat. So Bob wrote in, so he serves dentists who are selling their practice and planning to sell their practices. He sees a wide variety of AR situations. For dental practice owners who accumulated a late amount of 90 days AR, what is the preferred way to write off old AR? It reflects badly on practices when they are going to be sold, and 20-year-old AR is not really reflective of what is going on now.
Right, and that's it. You've got to get it off your balance sheet. So it has to be dealt with. If you start now and say you're looking at, because I'm looking at receivables in a practice I'm working with right now that are many years old as well. And you can't collect it. You're just going to go crazy. It's not worth the time and the effort. The person's probably even moved or died or whatever. They're not interested in paying this bill. It's old, and you're going to frustrate yourself trying to collect old balances. So we set some guidelines, and I said to them, what's your limit? How long back do you want to go? How far back are you willing to, pay me to go look for? Well, we're going to go back, a year. Okay, fine. What's the balance level at which you're willing to pursue it? Is it under 500 or over 500? What's your limit? So how old are you willing to go, and how large of an amount are you willing to go? And yes, definitely. I wish I could tell you how many dentists in particular are ready to sell their practices. And it's almost like, and the next step is I call a practice broker and I try to broker my practice, but they never beef the practice up before they contact the broker. And so, yeah, if you have people who are willing to work with you to try to sell practices, I would definitely encourage that you get in there with them. You talk to them about getting those old accounts taken off of there, and that they set up good accounts receivable policies. Get that cleaned up, because when the new buyer comes in, a lot of times they don't want to pass those practice receivables. They want to hold on to them. The buyer might want them, but a lot of times the seller wants to keep them. And that's fine. But the seller still is going to have to collect that, right? No one's going to collect it for him. His office staff is gone. So if the new buyer doesn't want the receivables, the old owner has to collect those in some fashion. So they still need to clean it up, even if they're going to keep the receivables. If, sometimes people will be like, well, you're in dentistry, so if you understand, you go in and the guy's like, my practice is worth $775,000. My wife said so, and that's the way it is. And they're not budging off their number. And the seller's like, that's it. That's all I'm taking. The buyer's like, I'm not paying $775,000 for this because of this reason and that reason, and receivables might be one of it, the reasons. And, you're like, both of you need to come to the table, because this is a good deal for both of you. Your practice you're getting what you deserve for your practice. One thing that people will sometimes do is offer then, okay, so will you let me have your receivables? I'll give you this, but I get to keep your receivables. So I'll give you the 775, but you're going to turn over your receivables to me. And it's good to tell them that if you have 0 to 30 to your new buyer dentist, that means they have an 85%, they'll have an 85% chance of collecting those new receivables. If you let those go down to 31 to 60, they'll have a 75% chance of collecting those receivables. If you go down past 90, they'll only have a 50%. If it's over 120, they have a 20%. So your accountant will actually go in and go, we're going to give you 85% value for your 0 to 30. We're going to give you 75 for your 31 to 60, et cetera. And then they're going to come up with a number. And a lot of times business deals are made because, the owner dentist says, yeah, I'll just sell you my receivables too. That way I get my 775. You've got the collection headache. And the guy taking it, the woman taking it is like, well, I know I'm not going to get the full price of this, but I'm going to get something out of receivables. Does that answer your question?
Yep, looks like it. Thank you, Bob.
Okay. So AR aging shows the length of time that a debt's past due. So we're going to always tell you, don't just look at how much is owed in general, like, oh, someone owes me $1.7 million. Look at the buckets, the aging buckets, because it depends, like I just was explaining, the value of those receivables changes as it gets older because of the collectability of the debt. So the aging bucket divides the AR into buckets based on the elapsed time since the invoice became due. So when you keep an eye on your invoices that remain unpaid, the business can intervene before they get old, because when they get old, we know we're going to have a heck of a time getting the money from anybody. So this is how it works. The unpaid or open customer invoices, which are your receivables, are grouped according to when the payment is due. Current means the open receivables, though they remain current until the due date. So if an invoice is dated for July the 24th, it's due on August the 23rd. So on an accounts receivable report that you run on August 1st, right, it's still current because it's only a few days old from July 24th to August 1st. It's just a few days old. So if you ran an accounts receivable report before it was due, that particular invoice is going to be labeled as current. It becomes past due on day 31. So in our example, August the 24th is day 31. So at that point, the invoice is past due. If you ran an aging report on September 1st, then that invoice would be 8 days old, and it would show up in the 1 to 30 day bucket on your accounts receivable report. Then they become severely past due. If you run another report, so on October 1st, now that same invoice is 38 days past due, and it's going to show up in the 31 to 60 day bucket. I'm going to mention here benchmarking, and for people in dentistry, or medicine at all, you can benchmark your receivables really easily. You can just do a Google search. There are benchmarks for every industry. There are ways, if you have trouble, contact me and I will try to help you find some benchmarks for your business if you're concerned about how much of my receivables should be in each of these buckets, how much should be current, how much should be in 31 to 60, etc. That's what this little chart is showing. The vast majority of your receivables should be current. So that's the 0 to 30, right? They're not yet past due. Only about 15% of your receivables should make it past into the 31 to 60 day range. The 61 to 90 should be 8% of your receivables. That means those are the ones you need to be dealing with. Those are the ones you need to get active on because your ability to collect is going down, down, down. I don't like, even though I got this from Dun & Bradstreet, I don't like the age of receivables at 90 to 120 being 14%. I see no reason to go there. I would deal with things at 90 days and 120 days at the outset. Now, there are extenuating circumstances. You might know this person had a stroke, for example, and they're not, they're a reliable customer. They've always paid you down to 0 in the past, and you're extending them some extra grace, right? You're giving them some more time. You're going to have situations like that, and you're going to have people in that situation. But I would always aim to keep everything 90 and above. That's your best chance of collections on these old accounts. So it might be hard to get to 60% current, but let that be like your imaginary dream goal. If you can get in the high 50s or in the 50s at all, from what I've read, most people consider that functioning at a good level. And this is why, because time matters. The longer the debt remains uncollected, the less chance you have of collecting it. So I got this from Dun & Bradstreet. Also, 95% up to 30 days, you'll collect 95%. That's why in Bob's example, if you're going to sell a practice, you can say to them, look, 85 to 90%, 95% of this is collectible. If I sell you the whole collectibles, you've got some money there, some value right away, some money in the pipeline, which is great for a new practice or a practice it's not new, but it's new to this new owner. If you wait and get it up to 60 days, you're going to collect 90% of it. And you can see it steadily drops off. By 90 days, you're only getting, close to 70%. And that's why I advise people try to keep it in that 90 to 120 days is the legal limit. And then after that, you either take it off your balance sheet by write-off, or you turn it over to collections if you're able to do that. Keep in mind also that debt collection agencies will take 25 to 45% of the amount owed, depending on who you go with. So if you keep the debts low in-house, then you don't have to use them very often. Cash is king. That's the way it is. So we're going to look at some accounts receivable reports. This is what should be printable on your computer. If it isn't, you can still do it the old-fashioned way. You want to have a client name column. You want to have amount due. That's highlighted in purple here. And then you're going to have your aging. So you can see in this example, each person is listed the amount due to the business. Remember, receivables are always current. So that 0 to 30 days are those current receivables. And there's $1,950 if you look at the total column at the bottom, running horizontally. There's $1,950 of what's owed to this business in the 0 to 30 days column. And the total amount I've circled in green is $5,009 that's owed this business. So it's not a big business, is it? The next part of the column is the buckets. So we have these highlighted in blue. You got the current, which is 0 to 30, the 31 to 60, the 61 to 90, and so forth. So these are the buckets that each of these receivables are in. And then you can see the percentages. This is super important. Always make sure that you calculate the percentage of that receivable that's in that bucket compared to the whole. That helps you understand how much is really owed to you. So we're going to do a little math problem. So I just copied this over. So we're going to look at Hillside. They owe a total of $900, and 300 of it is current, right? And 150 of it is 31 to 60, and then 375 is 61 to 90, et cetera, as you just follow that across. So in 0 to 30 days, the way to calculate the percentage of what is owed in that category is you take the 300 that they owe over the 900, the 300 that's current over the 900 that they owe. And that is 33.33% of what they owe is current. If you look at the 31 to 60 day column, you'll see that they owe 150. So 150 that of the 900 is owed is late. It's 31 to 60 days in your receivables. And so 16% of what is owed to the business from this person is in the 31 to 60 day column. And you can do that with any of them. And then at the bottom here, running along, I circled it in green. You can do an average of, so how much is my average? So remember before I showed you the circle, and it said so much percent should be current, and I said it was 60, around 60. So I've circled their current is 34.09. So they're way low in their current, right? They should have closer to 50 or 60% of what's owed to them in current. And then I said that the next bucket was 15%. You can see that they have 22.76% in that next bucket, the 31 to 60 days. So they're not doing too bad there. They're a little over what should be, but you can see where their real problem is as you move forward. 17.1 or 41, 17.16 of their receivables are owed, are in the 61 to 90 day range. So we know that the collectability of that 61 to 90 day range is less than what was earlier. And then 14.5% of the receivables owed to this company are way overdue in the 120 day range. So you can see where this happens in business all the time. And in specific, I can mention that one of the clients I'm working with right now, very low 0 to 30 like this, very high 90 and above. So, you know, the chances of them getting much of their money back is not great. So we're now wise, and we're putting in place things to stop that from happening. You want to keep everything on the left-hand side of this chart as much as you can. So there are two things that you can look at that you can do with that chart. One thing you should look at is the turnover ratio. And this is going to tell you how many times you converted that money that's in the pipeline in your receivables into cash. So what you do is you, again, if you're interested in learning how to do this, you can give me a call, just kind of listen for the details, but you're going to give me a call and I can help you if you really want to find this out. And it's important to know this, especially if you're going to sell your business. It's important to know. People are going to want to know how well are your receivables managed, because they're buying your customers, right? If you have taught your customers that they don't have to pay you, that's a risk for people. And smart people will say, no, thank you. I don't want clients who behave badly. And they're already, you know, for 25 years have been doing business with you this way. I want clients who have been taught the right way to handle it. So this is why it's so important to keep this going for your business. It's kind of like keeping up with your car repairs when you want to sell your car and you have that record in your glove compartment that says, every time I rotated the tires and changed the oil. And it's the same way in business. Get your receivables going right so that you can prove to people that your business is handled well. And this is one of the things people will look at, the turnover ratio. So what you do is you basically take your net credit sales, which net credit sales are just your credit sales, those that you've offered on credit terms. You take out returns, because that obviously we don't want that in there. That money or that item has been returned to you, and you get rid of allowances that you have made. And so your net credit sales, and you divide that by the average of your accounts receivable balance. So in this example, I said the annual sales, the net credit sales were 400,000, and the beginning AR balance was 55,000 at the beginning of the year. At the end of the year, it was 45,000, And so we're going to take the average of that. So 55 minus 45 is 10, right? Or so that's 50,000, and we're going to divide that the net credit sales by that number that we get, that average that we get. And in this case, the average was 8. So receivables were converted to cash 8 times during the year. And most business people consider 7.8 a good ratio. So if you can turn your accounts receivable into cash 7 to 8 times a year, that says a lot about how well you've trained your clients to be your clients. The other thing you want to look at, this other ratio, is the number of days. And this is how long on average did it take your clients to pay you? And you do that simply by taking the number of days in the year, 365, and you use that number we found over here, the turnover ratio, which we said was 8. And in this particular example, it took almost 46 days for the company to collect their accounts receivable. That means people owe them money for basically 46 days, right? And 45 days and below is average. It's considered good. If you can get your turnover, your number of days ratio down to 45 days, that's a good ratio to look for. So these are 2 things that I would, besides just doing your accounts receivable and managing those and getting rid of the old debt, I would definitely be looking at these 2 ratios to make sure this is important for people who are going to buy your business. And eventually someone's going to buy your business, or you're just going to close it. So how can you really benefit from these schedules? Looking at the accounts receivable lets you know how effective your collection policies are. When you look at the aging, it can alert you to when you should reach out to customers. It should let you know if the reach out is being done. You're going to go, oh my gosh, you must not be calling people, because when we were calling people, this was much better. Now it's tanking what's going on. It helps you stay in contact with your clients. It helps them know that you value the relationship that you have with them. I value that I did the service and that you're going to pay me, and I want to keep our relationship. You can use whatever means are appropriate to contact your clients and make sure that you keep on top of that. It also lets you estimate your potential bad debt. So one thing is, we're talking to Bob, you don't want to write everything off in 1 month, or suddenly it's going to really tank your balance sheet. But they're going to use, your accountants are going to use that data to estimate the amount of potentially uncollectible accounts receivable. And then they're going to assign to it a ratio, a dollar amount that they think they can get. Much like I told Bob, if it's so old, you'll get 85%, you'll get 75%. If it's this old, they'll use a multiplier so that they can guess for you about how much bad debt you're going to have at the end of the year. And the older the bucket is, the higher the multiplier that they use. So you're going to get less for that. It's less valuable to you. And that bodes negatively for your business, especially for those of people who are looking to sell or maybe bring in a partner. No one wants to come in if your multiplier shows that you have a lot of uncollectible debt. It also helps us uncover that dreaded cash flow problem that I keep harping on. You have to proactively manage this. It will not go away. It will rule you if you ignore it. You are flying blind if you don't pay attention to your accounts receivable. That report that you print monthly is like a warning siren to you. It's to let you get on it before it's damaging your business or your ability to expand or your ability to sell, your ability to collect. So get on it. It has other values. It helps you evaluate your credit policies. Sometimes businesses extend too much credit to people, more than they can handle. So you've given someone, they're really thrilled because they got to walk out with half of their new house in their hand, and they may not be able to financially handle that. So if you have balances that are continually overdue, you should tighten down the amount of credit that you're extending to these people, or adjust the billing terms for your company. You're just not tight enough on the way you manage the credit. It helps you improve operations because, like I said, it alerts you to staff members who are not necessarily doing what you want. And of course, they're training your clients. If they're letting, oh, you're nice, I'm just not going to collect it from you. Oh, I like that old guy. I like this lady. And they're not collecting, your accounts receivable is going to reflect that. And so you can get on them and go, hey, look, we have policies for a reason. That's so I can pay your paycheck. It lets you also evaluate your fees. If your accounts receivable is in good shape and you're like, man, I have the right ratios, but I'm still cash poor. Maybe you need to look at your fees and see if you're charging what's the going rate for that product. That's another thing I run into. We've discovered in this one client's office that our fees are not compatible with what's in the general in their area. They could get different fees than what they're charging. So if everything looks in order, you can look back at your fees and say something's not right, something's not happening right. And then obviously we've spoken about this at length, of succession. Receivables do have value to the buyer. Again, in healthcare, a lot of times people are like, I'll keep my own, but they have then receivables. If you're retaining them, they have value to you. So it's best to get everything in line before you rush ahead. So, you know, in Bob's situation, I would and have actually offered suggestions like this to people. Get your stuff in order while you're still kind of got your shingle hung out and you're thinking about getting out of the business, and get everything in order, get new policies in place. Because if you retain those receivables, you want as many as you can get. That's part of your retirement package. If you want to sell those to the new buyer, that's important that they have ones that they're sure clients have been trained correctly on how to pay your practice. And that also has some monetary value to them that helps them get more out of the practice. That's something in their pipeline. So AR informs cash flow. Can I pay my obligations? It lets me know if my receivables are low because I have low production or sales. I can do something about that. I can start, you know, incentivizing my salespeople or whatever. It lets me know about my credit policies. Am I too loose or too tight? It lets me know about what amount of bad debt I'm going to get sacked with that has to be written off, that I'm counting on. If you look at the receivables, you might feel rich. But if you see much of it is in the old categories, that's probably going to be written off. And that doesn't mean anything to you then as far as buying power. And then pricing, like I just said, are my fees reasonable? Am I priced right? Am I competitive with other people in my industry? So I like this Jack Welch, you know, quote, if I had to run a company on 3 measures, those measures would be customer satisfaction. Yeah, that's number 1, right? Employee satisfaction, which is a close second, and definitely cash flow, which I almost want to put that above customer satisfaction. You're in business to make money, and you're in business to make your dreams come true. And that's the best that you can do, is to keep track of your accounts.